All right, why don't we just get going, and hopefully others will join as you guys are talking. So thank you everyone for joining us today. My name is Rick Tomney, and I'm one of the managing directors at Little Harbor. And Little Harbor is a boutique asset management firm out of Boston. And we have a few firms that we are working with that are affiliated with our firm. One of which is Thompson Capital Management out of Chicago, and Mike and Matt Thompson are on call today, and they're going to bring you through a couple of strategies that we currently represent with them, the Alpha Seeker strategy, as well as the Smart Index strategy. And both of these strategies are available in an SMA format, and currently the Alpha Seeker is available in an ETF that was launched a few weeks back, and the Smart Index is scheduled to be available hopefully in the next month or two. So they have pretty interesting strategies. The track records go back on the Alpha Seeker goes back to 2011. Smart Index goes back to 2016. So without further ado, I think I'll pass it over to Matt and or Mike to get through the process.
All right, thanks, Rick.
Yep.
This is Mike. So we are brothers, by the way, if the last name confused anyone. Been working together at various firms since 2003. Quick background on us, kind of will make sense of why we're all sitting here on this call today. I started my career in Chicago in '96 at Northern Trust. Kind of traditional buy-side portfolio management upbringing in the business. Matt joined Northern in '99, moved over to William Blair in Chicago in 2000. Is the first investment firm I started doing derivatives at, inside 40 Act mutual funds, and then some custom options work for single stock hedging and that kind of thing. Really the first experience using derivatives to sort of change traditional portfolio performance characteristics. Our career arc has seen, the dot-com boom and bust, '08 great financial crisis, the European debt crisis, and now I guess the COVID crisis can be this most recent one. Really shaped our investment philosophy and investment approach and led to the development of the products that we're going to show you here today. It wasn't until 2008 when Matt and I were working at a family office where we had the broad enough mandate to develop product that kind of met what we wanted. Investment approaches and products that were more robust, didn't rely on crystal ball type investing, where our assumptions or our future estimates of earnings or GDP growth or whatever else fundamental characteristics that were important, those didn't necessarily need to come true for us and our clients to make money. We've really focused on the VIX marketplace since 2008. We've developed a model that we call the VIX dashboard that provides a variant perception and view on how to position our portfolios. It's not really a mechanical trading system, the VIX model. It's far more a method of analysis and decision making than it is a mechanical trading model. So we're pretty happy with the results of the products that we've developed, especially in the most recent turbulence. And Matt will walk us through some of the details of the products. And feel free to stop us anytime with questions.
Yep, thanks, Mike. So Thompson Capital, our focus is risk responsive investing. So as opposed to, I guess, risk unresponsive, i.e. buy and hold investing. We change our exposure to the market based on, in both of our strategies, all of our strategies, we change our exposure to the market based on our read of risk aversion in the marketplace. And we do that by monitoring the VIX through what we call our volatility dashboard. So I'll go through that in a second. We're a specialist asset management firm, though. We generally work with other advisors, and we manage portions of an overall portfolio for advisors and their clients. Quickly on the philosophy of the firm, as Mike alluded to, we've been in the industry for 20 years, and that's the length of this chart here. The black line is the S&P 500. I've circled some of those crisis periods there. We've seen 3 of them in 20 years. And these are major ones, 30, 40, 50% drawdowns, peak to trough. And obviously, as an investment advisor, having clients that are in retirement or near retirement, saving for retirement, a 30%, 40% drawdown in the bulk of your portfolio, which is, equities, that could really change your plans and alter your future. So our idea is, let's focus on those crisis periods. And the blue line is kind of the conception of that, or the philosophy here, that if you, I'm showing you the blue line is 50% downside capture, so half of the downside of the S&P. If you were able to achieve that, then you could even put up something like 80% upside capture, so even less than the market in good years, and come up with the blue line. And that's obviously a higher market value, and that's an easier path to get to that higher market value. So it's really a win-win for the client there. Easier path, better outcomes. That's what we're trying to get done in both of our products, all of our products. And how we do that is by listening to the message from the VIX marketplace. So the VIX index has been around since the 80s. It does some math on option prices to arrive at one number that is the index that it really represents risk aversion in the marketplace. It represents the demand for hedging against equity risk. So a high number like we saw in March, in the upper 80s, that's a high risk aversion, high demand for protection, and vice versa. In 2017, we saw it as low as 8. So really, in the last 5 years, we've seen literally the lowest VIX ever and the highest VIX ever. Our volatility dashboard is a system that watches all the trading in the VIX marketplace. So the tradable instruments, the VIX index itself is not investable. The tradable instruments in VIX, the futures and the options, and then the ETFs, came along in 2004. And from that point, the VIX, that marketplace, has really grown to become the world's premier marketplace for hedging. So it's our idea to watch all of the activity in that marketplace, watch the institutions and investors that use that marketplace to specifically express a view on volatility. There's a lot of information in that trading. So our dashboard is designed to go watch all that trading and kind of put together all of the information for us and provide it to us in a clean format. And conceptually, what we're looking for in that dashboard is we compare near-term volatility to medium-term volatility. That's what we're doing. There's a lot of nuance to how that works, but conceptually, that's really it. And we're showing you in this chart here. This is the S&P again, color-coded by either a calm state based on that relationship, or a stress state. And so the calm state is in the black, and that's when volatility today, the near-term prices are below medium-term. That's the natural state of affairs. That's when the market tends to rise. And you can see the black periods there. There's volatility in the market. I mean, this is equities, but it's a rising pattern, normal volatility. And the red is on the other side, when there's something acute enough that bothers the market to move near-term prices of volatility above medium-term ones. That just indicates that there's some kind of stress in the marketplace that is being not just worried about, but actually someone is putting dollars to work, buying contracts to protect against something right now. And so when we see that, that's the red periods. And obviously those red periods, they don't always lead to a crisis, but that it's kind of like a tornado warning system. The near-term prices being over medium-term is a precondition for crisis periods. That is like kind of the marker of a crisis. It doesn't always mean one is imminent, but that's the conditions under which crisis periods do happen. So you can see a lot of those small little red kind of dots there on the chart. Those are kind of when the storm clouds gathered up, no crisis came. But then you can also see the other times in the 2008 period, 2011, and then just this year with the Corona crisis. We saw that signal. The market really had a tough time there. So our idea at Thompson Capital is, when we don't see those crisis conditions, when the market is in the black kind of period, we're going to be the S&P 500 or be the market. We invest at the index level, generally through ETFs. And then on the other side is when we do see those crisis conditions, we're going to decrease our market exposure. And we can do that a couple different ways depending on the product. So Smart Index the name index is in the name. The word index is in the name because we own the S&P 500 all the time in this product. We have a version that's coming out as well that does own the NASDAQ index. So really this can be applied to really any index that is relatively correlated to the S&P. But in Smart Index, we own the S&P 500. I've broken the chart here into the two sides, the signals I just showed you. On the left, with the signal off, is kind of probably about 80% of the time. The most common outcome is that there's no crisis conditions in the VIX. During that period, we're going to be exposed to the S&P 500, 100 to maybe a little bit more than the S&P on a notional basis, and we can do that with combos of ETFs. And then in the Smart Index ETF, we can use futures and options to get that same type of exposure as well. And additionally, we can, depending on your setup as a client, we can do cover calls over those S&P positions to generate a little additional return with that strategy. And the goal here is just high correlation to good markets. So we're on board with the passive indexing kind of mantra here while things are going well for the market. On the other side is on the right side here, the red, and that's the periods when those crisis conditions are around, when we see the VIX prices twisting where the short term is over the medium term. And when we see that, we're going to decrease our S&P 500 exposure. We do it two ways. One is just selling down a little bit of the S&P positions themselves, so just taking the gross exposure down. And then two is buying a volatility exposure. In our SMAs, we do that with ETFs. So we can buy a volatility ETF that goes up in price when VIX goes up, when volatility rises. And that's really the defining characteristic of a crisis, is volatility rising, uncertainty rising. So the idea here is when we have this portfolio on, that the volatility profits offset any S&P losses. And the goal then of the whole portfolio would be to avoid a crisis period. So those big major drawdowns, not every little down day. It's what we're after is it's too expensive basically to protect against your odd 1 or 2% days. What is worth protecting against are the big drawn out drawdowns. Sometimes they're not even that drawn out. Like this year, I think we're down 35% in about 2 weeks in the S&P. That can happen too. Those are the types of periods we're trying to protect against because they make the most difference to your compounding and your results over time. So I put it in a box here. We're not a bad day preventer. We don't carry insurance all the time because it's too expensive a proposition. That means that we get more of the upside than most hedge equity strategies. And then when we actually do jump in, it typically takes about a 5% decline in the S&P before these crisis signals start to fire and we start to get active. And then in a true crisis scenario like we saw in March, we can really, these VIX positions can really outperform for us. We were up 19% in March in Smart Index, just because volatility went up so quickly. And we had a true crisis there. So our volatility positions much outstripped the S&P positions. So that's Smart Index. And the whole point, obviously, with all of our products, as we kind of getting back to that philosophy, is improving portfolios. So we're showing this here with Smart Index as a demonstration of how you might use it in a portfolio. This is real numbers from November of 16 through 2020. On the left here is a 60-40 portfolio, so 60% stocks, 40% bonds, rebalanced monthly since November 16, about 7% annual, close to 9% vol, 12% drawdown here, peak to trough at one point in the 60-40. And we're comparing it with, if you replace the S&P, just unhedged index level S&P with Smart Index, you can see return picks up, risk goes down. That's the ideal combination for most advisors. And I would just point out here, again, we're doubling the return of an unhedged portfolio with lower volatility and half the drawdowns. And we're doing that not because we're levering up or taking more risk. It's actually because we're defending against those crisis periods so far very well. So we actually have this portfolio using Smart Index actually has negative down capture, meaning we've profited a little bit in all the down periods over this period. And actually, there's that up capture 77%. That's not 100. It's not 150. It's a little bit less than the market on the upside, but we more than make up for it with the risk control on the down. So that's Smart Index. Very related product, just to finish the thought here, is Alpha Seeker, which this one has been around for a little bit longer. This is the original way we used the dashboard coming out of the family office in 2011. Alpha Seeker takes the same signaling, listens to the same message from the VIX, except it is not owning the S&P at all times. It's a truly uncorrelated return profile, and it just moves beta. It uses S&P 500 and VIX instruments, but basically just to move the portfolio beta between positive and negative based on kind of what the VIX message is. So the idea here is low correlation, kind of consistent, more like an absolute return profile here. And this strategy generally can be, would typically be a smaller portion of a portfolio than, say, Smart Index, which can take up, your S&P type allocations. And won't belabor the point here, but again, a proven portfolio, that's the point. Alpha Seeker, we're showing you 20% allocation in that same 60-40 mix. Returns pick up because risk goes down. So that's what we're trying to get done. Two different kind of flavors to do it. And then we'll just go through quickly on the returns, just point out some things here. All right, so Smart Index first. We've been at it since 2016. Here's that 19% March. We also had an outstanding February 2018 was similar, where we had a big volatility burst quickly. That was kind of the VIX really helped us out in that scenario. So we were up 8% when the market was down, I think six or 8. So here's the annual returns. You can see we're trailing in all the good years. We're up but behind, and then we've outperformed in the down years. So that's how we've been able to double the return of the S&P over this time frame with less than 100% up capture. It's because of the risk control. That's Smart Index. Alpha Seeker, longer track record here with respect to 2011. I'm showing, you can see kind of in the icons we use for our different strategies. Alpha Seeker is a smaller pie slice here than Smart Index. That's because the correlation here is very low. I think we're about 30% correlation on a daily basis since 2011, even though the strategies outperformed the S&P over that time frame. Very low correlation means that can cut both ways for an advisor placing client assets. Last year we were down a little with the S&P up. We've also been up with the S&P down. It just zigs and zags differently and helps the portfolio in that way. Also having a nice year here, big March for us there. In both of these strategies, we rank on the Morningstar managed ETF database. So it's portfolios that use ETFs exclusively, like ours. Smart Index as of March 31st is number 1 of 990 portfolios on the 3-year return and on the 1-year return. And again, that's without ever outperforming on the upside, just on the downside. And then Alpha Seeker is up there. See if we can find it in the list here. Alpha Seeker is in, I believe, in the top 5. Yeah, here it is. So we're top 5 on the 5-year return for Alpha Seeker, and this is with very low correlation to stocks, bonds, hedge fund index, most other asset classes. So we're pleased with those results. And what questions can I answer?
Yeah, Matt, it's Rick again. So,
yeah.
I want to open everybody up to questions. Before we do, just a couple of quick comments. I think that these strategies actually fit really well within asset allocation programs. And what's interesting is I also think they're very complementary of one another, because when you look at Alpha Seeker with, their approach, that they are truly an alpha diversifier versus, a core replacement, whereas, Smart Index is more of a core replacement within most asset allocation strategies. So the idea is if you're satisfied with your beta management, but you want that diversified alpha, Alpha Seeker is probably the right call for that type of portfolio. Whereas if you want a little bit of help on your beta management and have something that's a little bit more dynamic than trading in some of the usual suspects like SPY and VOO, the Smart Index is definitely something to take a look at, because that strategy does really well in those market environments, as you can see. So just wanted to make that point. But please open up to questions if anyone has any. All right.
I mean, I can think of some FAQs if we want to try to think through that. Otherwise, you know, it's a bit to digest. So, you know, feel free to just reach out with anything and as you think of it.
Yeah, I would encourage anyone who is interested in learning a little bit more, you know, just give us a call over at Little Harbor, and we can help you, you know, cycle through what we're doing here and what the strategies are doing, get you in touch with folks to help you if you're interested in making an investment.
Okay, well, if that's it, then short and sweet, that's great. Feel free to follow up with any of us. Our website is thompsoncm.com, like capital management, and then there's lhafunds.com, has information on our MSBX ETF. And we put out a commentary and a blog on our website, Thompson Capital, so you can sign up there to get those updates. Other than that, thanks everyone for your time.
Yeah, thanks very much. Thanks, Mike and Matt as well.
All right.
Bye-bye.
Have a good night.